Wake up, look around your room, the bed you sleep in, the alarm clock on your phone, the coffee brewing in your kitchen, even the house you're living in right now. You think you made choices about these things. You think you chose the brand, the price, the lifestyle. But what if I told you that one single entity, a shadow colossus that most people had never heard of until a few years ago, owns a piece of all of it? We're not talking about Apple, or Amazon, or Google. Those are just the storefronts. We're talking about the landlord, the bank, the puppet master. We're talking about BlackRock. Imagine a company with assets under management so vast that if it were a country, it would be the third largest economy on Earth, right behind the United States and China. We're talking about over $10 trillion. That's a 1 with 13 zeros. That is more money than the GDP of Germany, Japan, and the United Kingdom combined. But wealth is just a number. What matters is power. And BlackRock has a different kind of power. It's not the power of a standing army. It's the power of the universal owner. They own a significant stake in almost every major public company in the United States. They're the top shareholder in Apple, Microsoft, Amazon, Facebook, Google, and virtually every bank, every pharmaceutical company, and every media giant you can name. They're everywhere. Yet, they're nowhere. They sit in the boardroom of the company that makes your medicine, and the company that sells you the soda that makes you sick. They own the news network that tells you what to fear, and the defense contractor that builds the weapons to fight that fear. So, the question isn't just who is BlackRock? The terrifying question is, who controls BlackRock? And what is their end game? Is this just capitalism working as intended? Or have we stumbled upon the greatest monopoly in human history? One that doesn't just control oil or steel, but controls the very flow of capital itself. In this 6-part series, we're going to pull back the curtain on the Shadow Empire. We're going to deconstruct the life of Larry Fink, the man who arguably has more influence over your daily life than the President of the United States. We'll dive into Aladdin, the supercomputer that effectively manages the global economy. And we'll confront the dark theories about housing, ESG, and the Great Reset. If you thought Rockefeller was powerful, wait until you meet the machine that makes Rockefeller look like a small business owner. Welcome to the world of BlackRock. To understand the beast, we must first understand its creator, Lawrence Douglas Fink. Larry. He doesn't look like a Bond villain. He looks like a regular guy. Maybe an accountant or a high school principal. He speaks softly. He wears glasses. He talks about purpose and sustainability. But don't let the mild demeanor fool you. Larry Fink's rise to power is built on a foundation of one of the most painful failures in Wall Street history. The year was 1986. Larry Fink was a star at First Boston, a major investment bank. He was a pioneer. He helped invent the mortgage-backed security market. Yes, the very same financial instrument that would eventually blow up the world in 2008. But back then, he was a golden boy. He added $1 billion to First Boston's bottom line. Then, disaster struck. He made a bet on interest rates. A big bet, and he was wrong. In a matter of weeks, his department lost $100 million. In the 1980s, that was a career-ending sum. Fink went from hero to zero overnight. He was humiliated. He was pushed out. But in that darkness, in that humiliation, a seed was planted. Larry Fink realized that Wall Street was blind. They were all gambling. They didn't understand risk. They didn't have the technology to see the dangers lurking in their portfolios. He decided then and there that he would never be blind again. He would build a company that didn't just manage money, but managed risk. In 1988, with a small team of partners, he founded BlackRock. Originally, it was just a small arm of the Blackstone Group. But Fink had a vision that was different from the private equity sharks of the 80s. He didn't want to buy companies, strip them, and sell them. He wanted to be the steady hand. He wanted to offer passive investment products that were safe, reliable, and transparent. It sounds boring, doesn't it? Risk management, passive investing. But in the world of finance, boring is the ultimate weapon. Because while everyone else is chasing the next hot stock, the boring guy is quietly accumulating all the assets. The genius of Larry Fink wasn't just in risk management. It was in recognizing a massive shift in how the world saves money. For decades, if you wanted to invest in the stock market, you hired a guy, an active manager. You paid him high fees to pick stocks for you. But the data showed that most of these expensive experts couldn't even beat the market average. Fink saw the future. It was called the ETF, the Exchange Traded Fund. An ETF is a basket of stocks that automatically tracks an index, like the S&P 500. It's cheap. It's automated. It requires zero human guesswork. In 2009, in the middle of the global financial crisis, BlackRock made the deal of the century. They bought Barclays Global Investors, which included the iShares ETF brand. This was the moment BlackRock went from a big company to a global superpower. Suddenly, millions of regular Americans, people with 401ks and pension funds, were pouring their money into BlackRock's iShares. Every time you buy an S&P 500 ETF, you're essentially giving your voting rights to BlackRock. You own the economic risk, but they hold the political power. Think about the scale of this. BlackRock manages over $10 trillion, but they don't own that money. That money belongs to teachers, firefighters, nurses, and grandmothers. It's pension money. It's retirement money. But BlackRock controls it. They use that money to buy shares in every major corporation. And because the average person doesn't vote at shareholder meetings, BlackRock votes for them. This gave Larry Fink a unique position. He became the voice of trillions of dollars. When he walks into a room, CEOs listen. Not because he's a genius, but because he holds the keys to their stock price. If BlackRock dumps a company's stock, that company crashes. If BlackRock supports a board of directors, they stay employed. He became the kingmaker of capitalism. And for a long time, nobody noticed. Because who pays attention to who manages their 401k? It's boring. It's invisible. And that is exactly how the Shadow Empire was built. But managing $10 trillion is impossible for humans. You can't track millions of trades, thousands of portfolios, and global geopolitical risks with an Excel spreadsheet. To rule the world, Larry Fink needed a brain. A brain bigger than any human mind. So, he built one. It's called Aladdin. Asset, liability, debt and derivative investment network. Aladdin isn't just software. It is the central nervous system of the global financial economy. It is a supercomputer network that monitors every single trade, every single bond, every single stock, every single currency fluctuation in real time. It doesn't just manage BlackRock's money. This is the scary part. BlackRock leases Aladdin to other banks, other asset managers, and even insurance companies. Vanguard uses it. State Street uses it. The massive pension funds of Japan use it. Even Apple and Microsoft use it to manage their corporate treasuries. Estimates suggest that Aladdin monitors over $20 trillion of assets. That is nearly the GDP of the United States. Aladdin sees everything. It knows when a housing bubble is forming in Miami before the realtors do. It knows when a currency crisis is hitting Turkey before the politicians do. It runs millions of scenarios every day. What if oil prices double? What if a war starts in Europe? What if a pandemic hits? It's the ultimate crystal ball. And who controls the crystal ball? BlackRock. This gives them an information advantage that is essentially a cheat code for capitalism. They know what the market is going to do because, in many ways, they are the market. Critics call Aladdin the Eye of Sauron. It watches everything. And because so many major financial institutions use the same software, with the same risk models, there is a terrifying theory called herding. If Aladdin tells BlackRock to sell, and it tells Vanguard to sell, and it tells the banks to sell, everyone sells at once. The market crashes. Is it possible that a single piece of software could trigger the next Great Depression? Or is it the only thing keeping the chaotic system together? We'll dive deeper into the terrifying power of Aladdin in a later part of this series. But for now, just understand this. BlackRock isn't just an investor. They are the operating system of capitalism. If having all the money and all the data wasn't enough, BlackRock added a third pillar to their empire: the government. You might think Wall Street and Washington are enemies. That's the story they tell on TV. But in reality, they're often partners. And nowhere is this clearer than with BlackRock. In the 2008 financial crisis, When the big banks were collapsing, Bear Stearns, Lehman Brothers, AIG, the US government didn't know what to do. They didn't know which assets were toxic. They didn't know how to value the garbage mortgage-backed securities. So, who did the Federal Reserve call? They didn't call Goldman Sachs. They didn't call JP Morgan. They called Larry Fink. They hired BlackRock to clean up the mess. The government gave BlackRock the contract to manage the toxic assets of Bear Stearns and AIG. No bidding process. Just a phone call. Larry, we need you. Why? Because BlackRock had Aladdin. They were the only ones who could see through the fog. But think about the conflict of interest here. The government hired the world's largest private investor to manage a bailout of the private sector. BlackRock gained intimate knowledge of the government's strategy. They became the fourth branch of government. This pattern continued. When the pandemic hit in 2020, and the Fed needed to pump trillions of dollars into the economy to save it, who did they hire to manage the bond buying program? BlackRock. BlackRock executives move into the White House, and White House officials move into BlackRock. It's a revolving door that spins so fast it blurs the line between public service and private profit. Brian Deese, Wally Adeyemo, Thomas Donnellan, names you might not know, but they are the connective tissue between the Oval Office and Larry Fink's office. So, we've a company that controls $10 trillion of assets. A company that owns the supercomputer that monitors the global economy. And a company that is the first phone call for the President of the United States when the world is burning. Is this a conspiracy? No. It's out in the open. It's public record. But because it's boring, because it's complex, because it's buried in financial filings, nobody pays attention. Until now. In the next part, we're going to look at one of the most controversial aspects of BlackRock's influence: the housing market. You've heard the rumors. BlackRock is buying all the houses. You will own nothing and be happy. Is it true? Are they really trying to turn America into a nation of renters? Or is the truth even more complicated and sinister? We'll dig into the data. We'll look at the neighborhoods where Wall Street is outbidding American families. And we'll ask the question, is the American dream of homeownership dying? And is Larry Fink holding the shovel? Stay tuned. The rabbit hole goes much deeper than you think. If you've spent any time on social media lately, you've probably seen the memes. They usually feature a picture of Larry Fink or a generic corporate suit with a caption that reads, "You will own nothing, and you will be happy." It's become the rallying cry for a generation that feels locked out of the American dream. The price of a median home in the United States has skyrocketed. Rent is eating up half of people's paychecks. Young families are bidding on starter homes, only to be beaten by all cash offers that are 20% over the asking price. And the finger of blame is pointing squarely at Wall Street, specifically at BlackRock. But here is where we need to pause and separate the internet rage from the economic reality. Because the truth is actually more complicated, and in some ways, more worrying than the conspiracy theories. First, Let's clear up a massive misconception that floods the internet. Many people confuse BlackRock with Blackstone. They sound the same. They were once related. But today, they are very different animals. Blackstone is a private equity firm that has been aggressively buying up single-family homes for over a decade. BlackRock, until very recently, mostly stayed out of the direct housing market. However, that distinction is starting to blur, and this is why you should be paying attention. The anger directed at BlackRock isn't just about them buying houses. It's about a structural shift in the economy. It's about the financialization of the basic human need for shelter. Imagine a neighborhood where every house is owned by a corporation. There are no homeowners. There is no community equity. Everyone is a renter. The landlord isn't a guy named Bob who lives down the street. The landlord is a faceless ticker symbol on the stock market. This is the fear. The fear of a rentership society. And while BlackRock might say they don't own every house, the capital they manage is fueling the fire. To understand why this is happening, you have to think like an investor, not a homeowner. After the financial crisis of 2008, interest rates were slashed to near zero. Bonds, which used to pay a healthy return, were paying nothing. Investors, pension funds, insurance companies, sovereign wealth funds were desperate. They needed yield. They needed cash flow. Where can you find steady cash flow that keeps up with inflation? Real estate. Residential housing became a new asset class. It wasn't just a place to live anymore. It was a bond with a roof. Institutional investors realized something profound. Americans need to live somewhere. If they can't afford to buy because prices are too high, they must rent. And if you control the supply of rental homes, you have a captive audience. You can raise rents, and they have nowhere else to go. So, billions of dollars of institutional capital flooded into the housing market. They didn't buy mansions. They bought the starter homes. The 3-bedroom, 2-bathroom houses in the suburbs. Exactly the kind of houses that first-time buyers want. This created a mismatch. A regular family needing a mortgage simply cannot compete with a Wall Street firm making an all-cash offer with no inspection contingencies. BlackRock has defended itself against these accusations. They released a statement saying they are not buying individual houses in the way people think. And technically, for a long time, that was true. They mostly invested in mortgage-backed securities. But recently, the strategy shifted. BlackRock led a massive investment into Tricon Residential, a company that owns tens of thousands of single-family rental homes. By acquiring Tricon, BlackRock effectively entered the landlord business in a major way. Why does this matter? Because when a $10 trillion giant enters a market, it changes the gravity of that market. It signals to every other investor that housing is the place to be. It drives up prices. It turns a home from a sanctuary into a financial instrument. Critics argue that we're drifting toward a modern form of feudalism. In the old days, the lords owned the land. and the serfs worked the land and paid rent. Today, the lords are the asset managers, and the serfs are the middle class, paying 30 to 50% of their income just to have a roof over their heads. This isn't illegal. It is capitalism operating efficiently. Capital seeks the highest return. If renting houses to desperate families pays better than government bonds, capital will flow to houses. But is it moral? That is the question fueling the backlash against Larry Fink. Housing is the primary way regular Americans build wealth. You pay down your mortgage, you build equity, you retire with an asset. If that ladder is pulled up, if homeownership becomes a luxury for the top 10%, the wealth gap widens permanently. BlackRock argues they're helping. They say they're providing high-quality rental options for people who choose not to buy or can't buy. They say they're professionalizing the rental market. Try telling that to a young couple who has lost 10 bidding wars in a row. To them, BlackRock represents an insurmountable wall of money that is blocking them from the American dream. The optics are terrible, and for a company that prides itself on social responsibility, this is a massive vulnerability. It creates enemies on both the left and the right. The left sees corporate greed exploiting the poor. The right sees globalist elites destroying the independence of the American family. This brings us to the most controversial weapon in BlackRock's arsenal. It's not a gun. It's an acronym. ESG. Environmental, social, governance. On paper, ESG sounds wonderful. It sounds like doing good. It means investing in companies that care about the planet, care about people, and are run ethically. Who could oppose that? But in practice, ESG has become a lightning rod for controversy. And Larry Fink is the high priest of the ESG movement. Every year, Larry Fink writes a letter to the CEOs of the world's largest companies. These letters are not suggestions. They are marching orders. Because BlackRock owns a huge chunk of these companies, when Larry speaks, CEOs listen. If Larry says, you need to reduce your carbon footprint, the CEO of an oil company starts sweating. If Larry says, you need more diversity on your board, the board changes. Fink argues that this is stakeholder capitalism. He believes that companies must serve not just shareholders, but society as a whole. He argues that climate risk is investment risk. If the planet burns, your portfolio burns. Therefore, forcing companies to go green is not politics. It's prudent investing. However, critics see something very different. They see a non-elected corporate titan using other people's money to force a political agenda on the entire economy. They call it woke capitalism. Think about it. Did you vote for Larry Fink? No. Did Congress pass a law banning gas stoves or mandating diversity quotas? Maybe not. This is a form of shadow regulation. It bypasses the democratic process. It bypasses the voter. It concentrates the power to shape society into the hands of a few asset managers in Manhattan. The power of ESG has become so immense that it has triggered a war. Red states in America, like Texas and Florida, have started to fight back. They're pulling billions of dollars of state pension funds out of BlackRock. They accuse BlackRock of boycotting the oil and gas industry, which is the lifeblood of their state's economies. They say BlackRock is violating its fiduciary duty, the duty to make money for clients, by prioritizing political goals over profits. Larry Fink is now in the crossfire. He's being attacked by environmentalists for not doing enough, and by conservatives for doing too much. He recently said he has stopped using the term ESG because it has become too weaponized. But changing the word doesn't change the reality. The mechanism of control is still there. The question we need to ask is, do we want our retirement money to be used as a political weapon? Or do we just want the best return on investment? BlackRock says they're just managing risk for the long term. They say that a company that pollutes or discriminates won't survive in the future economy. They argue they are the adults in the room, thinking about the next 30 years. While politicians only think about the next election. There is merit to that argument. But there is also danger. When a single company has the power to force ExxonMobil to change its board of directors, or to pressure Coca-Cola on its hiring practices, we've entered a new era of capitalism. It is no longer the free market deciding. It is the managed market. Managed by Aladdin. Managed by ESG scores. Managed by BlackRock. In the next part, we will dive deeper into the mechanics of this control. We'll look at the circular ownership problem. What happens when BlackRock owns the airlines, the banks, the media, and the tech companies all at the same time? Does competition even exist anymore? Or is it just an illusion of choice? We'll also explore the terrifying theory of common ownership, which suggests that because the same big investors own all the competitors in an industry, those competitors have no incentive to lower prices for you. The consumer. The rabbit hole is about to get technical and even darker. Stay tuned. Next time you walk into a grocery store, try a little experiment. Look at the shelves. You see hundreds of brands. You see Coca-Cola sitting next to Pepsi. You see Dove soap sitting next to competitors. It looks like a vibrant, competitive free market. You think, if Coke raises its price, I will just buy Pepsi. That is the beauty of capitalism. Right. Competition drives prices down and quality up. But what if I told you that competition is largely an illusion? If you pull out your phone and look up the top institutional shareholders of Coca-Cola, guess who you will find at the top of the list? BlackRock, Vanguard, State Street. Now, look up the top shareholders of PepsiCo. Who is at the top? BlackRock, Vanguard, State Street. This pattern repeats everywhere. It repeats in the airline industry. It repeats in the banking industry. It repeats in big tech. Apple and Microsoft are supposed to be rivals, fighting for your loyalty. Yet, the same giant asset managers own massive chunks of both. This phenomenon has a name. Economists call it common ownership. And it is arguably the biggest threat to the free market that nobody is talking about. Think about it from the perspective of the owner. If you own both Coke and Pepsi, do you really want them to fight a brutal price war? Do you want them to slash prices to steal customers from each other? No, because a price war lowers profits for both companies. And since you own both, you lose money. What you want, as the common owner, is for both companies to keep prices high, stable, and profitable. You want a soft competition. Maybe they fight over marketing slogans, but they don't fight over the thing that matters most to the consumer: the price. This creates a situation that looks suspiciously like a monopoly, but legally, it isn't one. It's an oligopoly disguised as a free market. There have been academic studies suggesting that in industries with high common ownership, like airlines, ticket prices are higher than they should be. Why? Because the management teams of these airlines know who their bosses are. They know that their biggest shareholders also own their competitors. They don't need a secret meeting in a smoke-filled room to fix prices. They just need to act in the interest of their shareholders. So, when you see inflation sticking around, when you see prices going up and never coming down, ask yourself, is it just supply chain issues? Or is it because the fierce competition that used to keep prices low has been quietly suffocated by the fact that everyone is owned by the same three giants? We keep mentioning these three names together: BlackRock, Vanguard, and State Street. In the industry, they are called the Big Three. Together, they control roughly $20 trillion in assets. To put that in perspective, that is roughly the size of the entire GDP of the United States. They are the largest shareholder in 88% of the companies in the S&P 500. This concentration of voting power is unprecedented in human history. Not even the robber barons of the 19th century, like Rockefeller or Morgan, had this kind of broad, horizontal control across every single industry. Rockefeller owned oil. Carnegie owned steel. The Big Three own everything. And unlike Rockefeller, who was a visible target, the Big Three are mostly invisible to the average person. They hide behind the concept of index funds. They say, we are just tracking the market. But by tracking the market, they have become the market. This leads to a terrifying question about corporate governance. Who holds the CEOs accountable? In theory, it's the shareholders. But if the shareholders are just passive giants who own everything, who is watching the watchers? If a CEO fails, usually active investors would step in, fire him, and fix the company. But the Big Three rarely engage in hostile takeovers. They prefer engagement. They prefer quiet chats behind closed doors. This can lead to a culture of mediocrity in corporate America, where CEOs are protected by a wall of passive capital, as long as they say the right things about ESG and keep the stock price stable. We all remember 2008. We learned the phrase, too big to fail. Banks like Citi and JP Morgan were so massive that if they collapsed, they would take the global economy down with them. So, the taxpayers had to bail them out. Today, financial regulators are whispering a new fear. What if BlackRock is too big to fail? Think about the Aladdin system we discussed in part 1. It manages the risk for the entire global financial system. What if Aladdin has a bug? What if Aladdin gets hacked? What if the algorithms inside Aladdin make a mistake and tell everyone to sell at the exact same time? The systemic risk is concentrated in one company, in one software platform. If BlackRock were to face a liquidity crisis or a massive loss of confidence, the fallout would make the Lehman Brothers collapse look like a minor stumble. And here is the dark reality. Because BlackRock manages the retirement savings of half of America, the government cannot let them fail. If BlackRock goes down, your 401k goes down, your pension goes down, the economy stops. This creates a moral hazard. BlackRock knows the government has to backstop them. We saw this in 2020. The Federal Reserve stepped in to buy corporate bonds to save the market. And who executed those trades? BlackRock. They are essentially a government-sponsored entity in all but name. They have privatized the profits, but socialized the ultimate risks. However, trees do not grow to the sky forever. The sheer size of the big three is starting to create enemies. And not just conspiracy theorists on the internet. We're seeing a strange alignment of the political left and right. Progressives like Bernie Sanders attack BlackRock for being a symbol of extreme wealth, concentration, and corporate greed. They argue that 3 companies shouldn't have a stranglehold on the economy. Conservatives attack BlackRock for woke capitalism and using financial power to push a liberal social agenda without winning elections. This bipartisan anger is dangerous for Larry Fink. We are starting to hear the A word whispered in Washington, D.C. again. Antitrust. Just as they broke up Standard Oil in 1911, there are growing calls to break up BlackRock, to separate their technology arm, Aladdin, from their asset management arm, to limit the percentage of a company they can own. Larry Fink knows this history. He knows what happened to Rockefeller. And that is why he is on a massive PR campaign. That is why he writes those letters. He is trying to justify his power before the government takes it away. But there is another frontier of control we haven't touched yet. It's not about money. It's not about houses. It's about your mind. In the next part, we are going to look at BlackRock's influence on the media and the defense industry. Turn on your television. Flip through the channels. CNN, Fox News, MSNBC, CBS. It feels like a vibrant marketplace of ideas. They are shouting at each other. They disagree on everything. Politics, culture, economics. It looks like diversity. But let's look at the cap table. Who owns the companies that own the news? The Walt Disney Company owns ABC News. The top shareholders are the Vanguard Group, BlackRock, and State Street. Comcast owns NBC and MSNBC. The top shareholders are the Vanguard Group and BlackRock. Warner Brothers Discovery owns CNN. The top shareholders include Vanguard and BlackRock. Even Fox Corporation, the supposed rebel of the media landscape, has the same names on its shareholder list. This is the narrative factory. We are told that the media is the fourth estate, the watchdog of democracy. But what happens when the watchdog is fed by the same hand that feeds the pharmaceutical companies, the oil companies, and the banks? Critics argue that this ownership structure creates a subtle but powerful filter. It's not that Larry Fink calls the news desk and tells them what to say every morning. That is too clumsy. It is deeper than that. It creates a boundary of acceptable debate. You can argue about cultural issues all day long, but you rarely see deep, investigative reporting on the structural problems of the financial system. Why? Because biting the hand that feeds you is bad for business. When you realize that the same companies profiting from a housing crisis also own the news networks reporting on the housing crisis, the conflict of interest becomes blinding. They shape the story. They tell us who the villains are. And, unsurprisingly, the villains are rarely the asset managers. If owning the media allows you to shape the narrative of conflict, owning the defense industry allows you to profit from it. War is terrible for humanity, but war is fantastic for a diversified portfolio. Let's look at the titans of the American military-industrial complex. Lockheed Martin, Raytheon, Boeing, Northrop Grumman, General Dynamics. These are the companies that make the missiles, the fighter jets, and the drones. Who are their biggest shareholders? You guessed it, BlackRock, Vanguard, State Street. Whenever a geopolitical crisis erupts, whether in Ukraine, the Middle East, or the South China Sea, defense stocks surge. When the government announces a new $100 billion aid package, that money flows directly from the taxpayer to these defense contractors. And ultimately, it flows to their shareholders. This creates a perverse incentive structure. We have a financial system that essentially bets on global instability. Peace is bad for quarterly earnings. Larry Fink talks a lot about ESG and making the world a better place. He talks about sustainability. But how does investing billions in cluster bombs and fighter jets fit into a sustainable future? BlackRock argues that national defense is necessary for a stable economy. They say they are just providing capital to companies that protect democracy. And that is a valid argument. But it becomes uncomfortable when you look at the circular nature of the money flow. The asset managers lobby the government. The government increases the defense budget. The defense companies get contracts. The stock price goes up. The asset managers make a profit. And the media companies, owned by the same asset managers, spend 24 hours a day beating the drums of war, keeping the public afraid and supportive of increased military spending. It's a perfect self-sustaining ecosystem. The circular economy of conflict. Nowhere is this dynamic clearer than in Ukraine. While the war was still raging, while cities were being bombarded, a meeting took place. In late 2022, Volodymyr Zelensky, the president of Ukraine, had a video call with Larry Fink. They weren't discussing military strategy. They were discussing investment. They were discussing the Ukraine Development Fund. Ukraine is devastated. The cost to rebuild it is estimated to be over $400 billion initially, and potentially up to $1 trillion. Who is going to manage that money? Who is going to coordinate the investment to rebuild the power grids, the roads, the housing? BlackRock and JP Morgan, they are positioning themselves to be the architects of the new Ukraine. Critics call this disaster capitalism. First, you profit from the weapons that destroy the country. Then, you profit from the contracts to rebuild it. You make money on the destruction, and you make money on the construction. Larry Fink has called Ukraine a beacon of hope for the power of capitalism. He sees a massive opportunity to modernize an entire nation's economy from scratch, integrating it into the Western financial system. Let's pivot from war to health. The pattern is identical. Pfizer, Johnson & Johnson, Merck, the giants of big pharma. Their top shareholders are the big three. During the global health crisis of 2020, billions of dollars of public money were poured into vaccine development and distribution. The stock prices of these companies hit record highs. It was a windfall for investors. But here is the connection that makes people uncomfortable. The media networks, owned by the same investors, were the primary vehicle for promoting these pharmaceutical products. Again, this is not illegal, but it raises questions about the firewalls that are supposed to exist between different sectors of society. When the people making the medicine, the people reporting on the medicine, and the people regulating the medicine through the revolving door of government, all share the same financial masters. Can we truly trust the information we are getting? This is why trust in institutions has collapsed. People sense that the game is rigged, even if they can't see the strings. They feel that every crisis, whether it is a war, a pandemic, or a financial crash, always results in a massive transfer of wealth from the middle class to the asset holding class. And BlackRock is the ultimate symbol of that transfer. They are the bucket that catches the rain of money printed by the Federal Reserve. All of these threads, housing, media, war, health, have woven together into a massive internet theory known as the Great Reset. The term comes from the World Economic Forum, an organization led by Klaus Schwab, who famously meets with Larry Fink and other global elites in Davos, Switzerland, every year. The theory suggests that these elites are deliberately engineering crises to restructure the global economy. They want to replace shareholder capitalism with stakeholder capitalism, which sounds nice. But critics say it is just a code word for a centrally planned economy run by corporations instead of governments. Larry Fink is often painted as the villain of this story. The man who wants to force you to eat bugs, rent your house, and drive an electric car, all while tracking your carbon footprint. Is this true? Or is it just internet hysteria? The reality is likely somewhere in the middle. Larry Fink is not a cartoon villain stroking a cat. He is a capitalist. He believes that climate change and inequality are threats to capital. He wants to stabilize the world so that his $10 trillion can keep growing. But his version of stability looks a lot like control. It looks like a world where choices are limited, where consumption is monitored, and where the biggest companies get bigger while small businesses die. It is a technocratic vision of the future. A world run by algorithms and data, optimized for efficiency, but perhaps lacking in freedom. But there is one force that even Aladdin cannot predict. One variable that threatens to disrupt the entire BlackRock empire. It is a new technology that operates outside the banking system. It is decentralized. It is uncontrollable. And Larry Fink has gone from hating it to trying to own it. I am talking about Bitcoin. In the next part, we are going to explore the crypto pivot. Why did Larry Fink call Bitcoin an index of money laundering 5 years ago, and now calls it a flight to quality? Why is BlackRock launching a Bitcoin ETF? Are they trying to destroy crypto, or are they trying to tame it and make it part of the machine? We will also look at the emerging competitors to BlackRock. Is there anyone strong enough to challenge the king? Or have we reached the end of history for financial competition? The empire is pivoting again, and this time they are coming for digital gold. In 2017, Larry Fink sat on a stage, looked at the audience, and famously declared that Bitcoin was an index of money laundering. He dismissed it. He mocked it. He said it was just a tool for criminals and terrorists. Fast forward to 2023. The same Larry Fink goes on national television, on Fox Business, and says that Bitcoin is digitizing gold. He calls it an international asset. He says it represents a flight to quality. What happened? Did Larry Fink have a spiritual awakening? Did he suddenly become a crypto anarchist who believes in decentralized freedom? Of course not. Larry Fink is a pragmatist. He follows the money, and he realized that the money was moving. For years, the crypto industry was the Wild West. It was volatile. It was unregulated. It was dangerous for institutional capital. But it was also the only asset class that was growing exponentially while the rest of the economy was stagnant. Fink realized that his clients, the pension funds, the endowments, the wealthy families, wanted exposure to crypto. But they didn't want to deal with private keys, hardware wallets, or shady exchanges like FTX that might steal their money. They wanted crypto wrapped in a package they understood. They wanted an ETF, an exchange-traded fund. So, BlackRock filed for the iShares Bitcoin Trust. The moment they filed that paperwork, the entire psychology of the market changed. Before BlackRock, crypto was seen by Wall Street as a toy. After BlackRock, it became an asset class. The SEC, the Securities and Exchange Commission, had rejected almost every Bitcoin ETF application for a decade. But when BlackRock knocks on the door usually opens. BlackRock's record of getting ETFs approved was something like 575 wins to 1 loss. In January 2024, the Bitcoin ETFs were approved. It was a coronation. This pivot teaches us a masterclass in institutional strategy. BlackRock didn't try to kill Bitcoin. They tried to tame it. There is a saying in business, commoditize your complement. But BlackRock's strategy is different. It is financialize your threat. Bitcoin was created to be the anti-bank. It was created in 2009, largely as a response to the bailouts of the financial crisis. Bailouts that BlackRock helped manage. The ethos of Bitcoin is verify. Don't trust. It is about removing the middleman. But BlackRock is the middleman. They are the ultimate intermediary. By creating an ETF, they inserted themselves back into the equation. Now, instead of holding your own Bitcoin, you pay BlackRock a fee to hold it for you. Critics in the crypto community are divided. Some are celebrating. They say, the institutions are here. Number go up. They see BlackRock's entry as the ultimate validation that will push Bitcoin to $1 million. But the purists, the cypherpunks, are terrified. They argue that this is a Trojan horse. They fear that if BlackRock accumulates enough Bitcoin, they could potentially influence the network. Not by hacking it, but by controlling the mining pools, or by creating a paper Bitcoin market that suppresses the price of the real thing. There is also the issue of a fork. If there is ever a dispute in the Bitcoin network about an upgrade, who decides which version wins? In the past, it was the community. In the future, will it be the entity that holds the most coins? If BlackRock speaks for millions of investors, their vote carries a lot of weight. We are witnessing the corporate capture of a decentralized technology. It is no longer just a rebel currency. It is now a line item in a diversified portfolio, sitting right next to Apple stock and government bonds. But Bitcoin is just the appetizer. The main course is something Larry Fink talks about constantly. Tokenization. He has said, I believe the next generation for markets, the next generation for securities, will be tokenization of securities. What does that mean? Right now, the financial plumbing of the world is old. It takes 2 days to settle a stock trade. It takes weeks to close on a house. It involves mountains of paperwork, fax machines, and middlemen. It is inefficient. Tokenization means putting real-world assets, stocks, bonds, real estate, art, onto a blockchain. Imagine a world where you can buy 1/1,000,000th of a building in New York instantly on your phone 24/7. Imagine selling your Apple stock on a Sunday night and using the money to buy coffee on Monday morning instantly. This is the holy grail of efficiency. And remember, Rockefeller's ghost is always whispering. Efficiency is profit. BlackRock wants to build the infrastructure for this new world. They launched a tokenized fund on the Ethereum blockchain called BUIDL. It is a test. They are testing the pipes. If BlackRock succeeds, Aladdin won't just track stock markets. It will track everything. Every asset on Earth could potentially be represented by a token, trading on a ledger that BlackRock monitors. This would give them a level of visibility and control that makes their current power look small. It would reduce friction in the economy. Yes, but it would also mean that every transaction is tracked, recorded, and visible to the central operator. This connects back to the fears of the Great Reset. A fully tokenized economy is a fully surveillance economy. If your money is a programmable token, it can be controlled in ways that cash cannot. Is BlackRock unstoppable? Not necessarily. They face competition, but it is rare air up there. Their biggest rival is the Vanguard Group. Vanguard is fascinating because it is structured differently. It is owned by its own funds, which means it is effectively owned by its investors. It is a mutual structure. Vanguard has taken a very different stance on crypto. They refused to launch a Bitcoin ETF. They blocked their customers from buying them. They said crypto doesn't fit into a long-term portfolio. This created a massive divide. Vanguard is positioning itself as the conservative, boring, safe option for the traditional investor. BlackRock is positioning itself as the innovative, modern, everything option. Fidelity is the third player. They are aggressive in crypto, mining Bitcoin themselves since 2014. So, we have a clash of titans. But notice something. They are all American companies. The global financial system is overwhelmingly dominated by US asset managers. This creates a geopolitical tension. China does not want its companies owned by BlackRock. Europe is uncomfortable with American giants owning their infrastructure. We are seeing a trend of deglobalization. Countries want to take back control of their own assets. If the world fragments into different economic blocks, BlackRock's model of global dominance becomes harder to sustain. Before we move to the final conclusion, we must address the Black Swan scenario. The thing that keeps regulators awake at night. What if Aladdin breaks? We discussed earlier that Aladdin manages risk for $20 trillion of assets. But software is written by humans. It can have bugs. It can have biases. There is a theory called algorithmic homogeneity. If every major bank uses Aladdin to decide what is risky and what is safe, they will all react to a crisis in the same way. Imagine a sudden shock to the oil market. Aladdin's algorithms might signal sell, not just to BlackRock, but to Vanguard, to State Street, to the pension funds of Europe. Everyone rushes for the exit at the exact same millisecond. Liquidity evaporates. The market goes to zero. This is the flash crash nightmare. And because BlackRock is so integrated into the government, the Fed would have to print trillions to stop it. We have built a financial system that is incredibly efficient, but potentially incredibly fragile. We have put all our eggs in one very high-tech basket. And holding the handle of that basket is Larry Fink. In the final part of our series, we will bring it all together. We will look at the future scenarios. Will BlackRock be broken up by the government? Will it become the world's first corporate government? Or will it slowly lose relevance as the world decentralizes? We will also give you the user manual for living in the Shadow Empire. How do you protect your wealth? How do you maintain your independence? And how do you play the game when the dealer owns the deck? The conclusion is coming, and it might change the way you invest forever. We have traveled a long way. From the failure at First Boston to the $10 trillion empire. From the housing market to the war in Ukraine. From the ESG controversies to the Bitcoin pivot. We have seen how BlackRock and Larry Fink have built a machine that touches almost every atom of the global economy. Now, we must ask the final question. Where does this go from here? History teaches us that power hates a vacuum, but it also teaches us that trees do not grow to the sky. Every empire eventually faces a crisis of expansion. For BlackRock, that crisis is approaching from two directions. Scenario 1 is the breakup. Just as the government eventually broke up John D. Rockefeller's Standard Oil in 1911, there is a growing chorus of voices in Washington demanding the same for BlackRock. The argument is simple. No single entity should have this much influence. The concentration of risk in the Aladdin system is a national security threat. The conflict of interest between their advisory business and their investment business is too great. If a breakup happens, it would be the financial event of the century. They might force BlackRock to spin off Aladdin as a separate software company. They might force a separation between the passive index funds and the active trading desks. But remember the lesson of Rockefeller. When Standard Oil was broken up, Rockefeller actually got richer. If BlackRock is broken up, the sum of its parts might be worth more than the whole. The machine might change shape, but the money will likely remain. Scenario 2 is the corporate state. This is the scenario where BlackRock becomes so integrated with the government that they become indistinguishable. We are already seeing this. They manage the Federal Reserve's bond-buying programs. They advise the Treasury. They rebuild war-torn countries. In this future, BlackRock essentially becomes the Department of Capital Allocation for the Western world. It is a world of managed democracy, where voters choose politicians. But asset managers choose the policies. It is efficient. It is stable. But is it free? So, what do? You are not a billionaire. You don't have a lobbying team. You are just an individual trying to build wealth and protect your family in a game that is clearly rigged in favor of the house. Here is the user manual for surviving the era of the Shadow Empire. Rule number 1 is awareness. You cannot fight what you cannot see. Understand that when you buy an index fund like the S&P 500, you are feeding the beast. You are giving them your voting power. I am not saying you should sell your retirement account. Low-cost indexing is still a great way to build wealth, but be aware of the trade-off. You are trading political voice for economic efficiency. Rule number 2 is diversification beyond the system. If BlackRock owns the stock market, the bond market, and the housing market, you need to own things that they cannot easily control or dilute. This is why we talked about Bitcoin in part 5. It is the only asset class with a hard supply cap that no board of directors can change. It is an insurance policy against the debasement of the currency. But it's not just crypto. It's physical gold. It's owning your own business. It's owning land directly, not through a real estate investment trust. These are bearer assets. Assets that you hold, not assets that are just an entry in Aladdin's database. Rule number 3 is localism. The Shadow Empire operates at the global level. They don't care about your main street. They care about quarterly earnings calls. The best way to build resilience is to invest in your local community. Buy from local businesses. Support local banks instead of the mega banks owned by the big 3. Build relationships with people, not just algorithms. Larry Fink has a lot of power, but he cannot cancel your handshake with a neighbor. He cannot algorithmically optimize your garden. The physical, local world is the one place where human agency still wins. We also have to confront the moral dilemma. Many of us are hypocrites. We complain about BlackRock's power, but we love the convenience of Amazon, which they own. We hate the pharmaceutical industry's influence, but we demand the pills, which they own. We hate the housing crisis, but we cheer when our own home value goes up. BlackRock is, in many ways, a mirror. It reflects our own collective desires for safety, for high returns, for convenience. Larry Fink didn't steal $10 trillion. We gave it to him. We gave it to him in our 401ks, our pension funds, our insurance premiums. He is simply doing what the system was designed to do: aggregate capital and maximize efficiency. If we don't like the result, we have to look at the incentives of the system itself. We have built a world where money has no loyalty. It flows to wherever the yield is highest. It doesn't care about culture. It doesn't care about borders. It doesn't care about history. Larry Fink is the avatar of this stateless capital. He is the captain of a ship that is bigger than any ocean. Is Larry Fink a villain? It is easy to paint him that way. The Bond-villain comparisons are effortless. But in his own mind, and in the minds of his admirers, he is a visionary. He believes he is saving capitalism from itself. He believes that by forcing companies to focus on climate change and diversity, he is preventing a revolution. He believes that Aladdin prevents financial crashes. He is the modern John D. Rockefeller. Rockefeller believed he was bringing order to the chaos of the oil industry. Fink believes he is bringing order to the chaos of the global market. They both share the same fatal flaw: the hubris of control. The belief that a small group of men, armed with the right data and the right intentions, can plan the lives of billions better than the people can plan for themselves. History shows us that centralized control, no matter how smart, eventually becomes fragile. It creates single points of failure. If Aladdin is wrong, we are all wrong. The Shadow Empire is vast. It is powerful. It is terrifying. But it is not invincible. It relies on your consent. It relies on your capital. Every dollar you spend is a vote. Every dollar you invest is a vote. You can choose to vote for the mega corporations owned by the big three. Or you can choose to vote for the challengers, the disruptors, the local businesses, and the decentralized technologies. The future is not written in Aladdin's code. It is written in the choices we make every day. We have pulled back the curtain. We have shown you the gears of the machine. Now, you cannot say you didn't know. The red pill has been swallowed. What you do with this information is up to you. Will you be a passive passenger on the BlackRock train? Or will you build your own path? This has been the Shadow Empire. Thank you for watching. And remember, in the game of giants, the most dangerous thing you can be is unaware. Stay curious, stay independent, and we will see you in the next series.